relatively simple piece of information to know. The other thing about lines of credit, most banks that offer lines of credit, because typically you go to a bank to get a line of credit, okay? You don't come to someone like, well, my clients all come to me, and then I refer them to my relationship over at Synovus, and that works beautifully. But the banks that issue them, typically you only pay interest on the amount that's outstanding for the first 5 or 10 years, depending whatever the bank sets up. So if you think about it, if you have a $30,000 outstanding on your line of credit and the interest rate's 5%, that's $6,000 for the whole year. That's a $500 payment. No, I said that wrong. 5% would be $1,500. And if it's 5%, I mean, you're talking about, what, $125 a month? That's nothing on $30,000. Then you can pay it off as fast as you so choose. And then the line of credit is still there. Now, let me show you the way some people are using lines of credit. They've got a home that they own, and it's worth $400,000. And they're trying to buy the next home before they sell the one that they're currently in. Now, some banks don't want you to tell them that you're borrowing money on a line of credit so that you can purchase a new primary residence. They don't want to know that. So the rule is, in most of these institutions, they'll give you a line of credit, let you apply for it, but your home cannot be listed. If your home's listed, you don't get the line of credit. If your home is not listed, then you'll be able to apply for the line of credit and hopefully secure the line of credit. Now, here's something that's happened though. Lines of credit, HELOCs, home equity lines of credit, are busy right now. As a result of that, the time limit to acquire one is running at about 6 weeks or more. So if you've got somebody who says, I don't want to sell my house until I buy the next one, but I need the equity out of my house in order to buy the next one, and I can afford both mortgages, because they have to be able to afford both in that example. If they don't have a HELOC on their house right now, you got to tell them, apply for the HELOC right now before I list your home. It's going to take about 6 weeks. Let's get that set up. And that's how you can go about getting that line of credit set up. So lines of credit for people, not only for people buying homes, but just people who are trying to do improvements to their home. That's where you can use lines of credit. Yes, Lanier?
Any ding on credit score for opening a HELOC?
Good question. Are there any requirements for credit score requirements? Yes, there are. The higher the credit score, obviously, the better you'll get on the interest rate. But by the way, HELOCs are a variable rate. It's not a fixed rate, generally speaking. So it's going to be based off of prime plus something. Now, it depends on the institution. If you've got high 700 credit scores, no worries. You're going to get whatever you want. And I don't know exactly, but I think at Synovus you can go down to 670. Interesting thing, not all institutions, but I know with Synovus, if my wife and I are applying for a loan, a home equity line of credit at Synovus, and I've got a 720 credit score and she has an 800 credit score, they use the higher of the two rather than our business, which uses the lower of the two. So they're a little bit more flexible. Pedram?
So you said about 6 weeks is the process?
About 6 weeks to get a HELOC right now.
What else? So I have a client that's got like 6 properties. And is he able to do HELOCs if he owns the property?
Good question. Can they do HELOCs on investment properties? Most institutions will tell you no. There are some that do it. Usually rates are much higher. They're oftentimes, there's other factors that come into play. Most institutions, though, do not do HELOCs on investment property.
If they're in the process of, pre-qualification for the next one, will opening a HELOC impact the credit score at all? Will it lower?
Yes. Well, it might have an impact. Here's what I would tell people, though. If I've done your pre-approval, all right, bear in mind, you can't go if you don't have a HELOC yet and you need that equity, you're not going to be able to go and buy a house. You got to wait until you've got the HELOC secured. Once that is secured, then you can go out and buy a house. You put a contract on a house while you've got an application going with a HELOC, right away what you've just told the HELOC lender is that this is not going to be my house. I'm buying a different house as my primary residence. All of a sudden you just killed your HELOC. So if you're going to do that, you got to do the HELOC, leave it alone, don't do anything else until that is in place. Then execute your contract, list your home, do whatever it is that you're going to do. Trevon.
Do you think using a HELOC as maybe down payment on an investment property is a bad or good idea?
Say that again.
Do you think using funds from a HELOC to put down for an investment property is a bad or a good idea?
Oh, that's a good question. Is it, what do I think it's a good idea or bad idea to use money from a HELOC to purchase an investment property? That's very personal. I don't know that it's necessarily a good idea or a bad idea. It depends on the person's financial situation. My wife and I carry a very large home equity line of credit, and we use it for a variety of reasons, and that's one reason we will use it. If we found a property that we just wanted to get, if the property is a little bit more money than I have cash for, I'll pull some out of my home equity line of credit and apply it to what I have. And then, because if I'm buying investment property, I'm trying to buy it for cash. Okay, if I can afford it. Sometimes it's goofy, but so you can. It's not that it's a good idea or bad idea. It's personal. Yes, ma'am.
How long do you have to own a home until you can get a HELOC?
Usually, good question. How long do you have to own the property before you can get a HELOC? I mean, you can almost get it within 6 weeks. Now, some institutions are different. Some institutions may say you got to be in the house for 3 months or 6 months or whatever. But usually, right after you get the house, you can make application for a HELOC, and they'll tell you whether or not that you can get the loan. One thing I will tell you, HELOCs have changed a lot. And the reason I say they changed a lot is, like, for example, Wells Fargo used to be one of the largest HELOC lenders in the country. They got out of the business last year. They got out of HELOCs completely. Most HELOCs, if you went and got a home equity line of credit, the bank would pay all of the closing expenses minus maybe a couple $100, and that was it. And if you paid it off early, you'd have to pay a small penalty, a couple $100 and done. That's changed. Most HELOCs today, if you close out that HELOC within 3 years of the time that you opened it, you're going to have to pay the closing costs that the bank paid. And the closing costs on HELOC are not as bad as closing costs on a loan. If you had a $100,000 home equity line of credit, your closing costs are going to be somewhere between $1,000 to $1,300. And so if you pay it off in 3 years, you got to pay all that back plus a penalty usually of $200 to $250 to the bank.
Would there be any penalty if you opened it and then didn't actually access it and then closed it?
Yes.
Yeah.
Same thing, inside 3 years, whether you use it or not. Okay, yes, there is a penalty. Some institutions, if you don't use it over a certain period of time, they may start charging you an annual fee just to have it. I got hit with that, and I had to call the bank and say, really? With all the business? They said, Greg, we got you covered. I said, thank you.
Is a HELOC the same as using cash?
I'm sorry?
Getting a HELOC to purchase a home, is it the same as having cash?
Yes, yes. For example, if you've got a HELOC for a couple $100,000 and you find an investment property that you want to go buy and it's $150,000, you just take it right out of your HELOC and pay cash. You're done. Oh yes, that's a great tool. But the problem is, where do you find a home today for $150,000?
Rome?
For that matter, where do you find a home today for $200,000? Trevon knows where. You know who else can find property at that price is, Jay. She's got this one investor that I help out with things, and he's buying property up, like, of course he's buying these little small homes that his dad's a contractor and fixes all up and does all that. But I mean, he's finding a whole bunch of homes below 200,000. I'm like, okay, God bless you, buddy. You know? Yes.
If you are using a HELOC to buy your next home, can you set it up so that it gets paid off at closing? Mm-hmm. Yeah.
Yes. Just pay it off. Well, it has to, because it's a home equity, which means it takes second position to the first mortgage. So if you have a loan on the house for $300,000, you have a HELOC for $59,000, you owe $359 on the house, and you sell the house for $4.25. When you go to sell that house, you got to pay off the first mortgage, and then you're going to close your HELOC. If you've got a balance on it, they're going to pay it off. If not, you're just going to close it. Good questions.
What income and employment qualifications are there for HELOC?
What income and employments? Great question, Pedro. Are applied. Every institution is a little bit different, but very similar to what we have. Now, their ratios are a little bit more loosey-goosey than mortgage lending. You're probably going to be looking at least somewhere up to 50%, and they'll let it go. So you get quite a bit of flexibility on the HELOCs.
Are they evaluating the current value of the property?
I'm sorry?
When you're doing the application with whatever bank you're using, are they evaluating the current value of the property to determine what the equity?
Yes, they are. They're going to, it depends, a lot of times, depending on where the home is, how much, they may or may not have to do a full appraisal. Sometimes they'll just do a drive-by, which saves money, especially if it's in an area that's pretty hot and they know the area, they might just do a drive-by. Sometimes if it looks like it's, the price is pretty high that they're estimating, then they'll go out and do a full appraisal. All right, before I go on to bridge loans, which I want to touch base on because I want to do a comparison for you, questions that you have, any other questions on HELOCs? We kind of skimmed over that, but it's important information so you know how to use them. Now, I'm going to give you the traditional bridge loan and then show you how you can use a HELOC as a bridge loan today. Traditional bridge loans. First of all, bridge loans have always been a little bit more expensive, and a bridge loan is just what it says. It takes the equity out of your current home so that you can use that to bridge what you need to purchase the next home as your down payment. So you could say, well, Greg, that's what you just explained. Well, it is and it isn't. In a bridge loan, the lender that would give you that bridge loan or the HELOC, they know you're using the money specifically for a down payment on your next home. That's what it's used for, and you don't have any choice. You can set up the bridge loan, but they're not going to give you the money. It's not a line of credit. They're going to give you X amount of dollars. In this example, now, I told you 89.9% on HELOCs, on bridge loans, capped at 80. So if you have a home that's worth $400,000 and you owe $300 on your first mortgage, the amount available to you is only $20,000, not $59,000. So bridge loans, first of all, are capped at 80% combined loan to value. That's number one. Number two, there's more cost involved. The first cost that you pay is when you do bridge loans, you always pay an origination fee. Most institutions, depending on the size of the loan, are going to charge you anywhere from 1% to 0.5% origination fee, which you will not have if you're doing a HELOC. But bridge loans used to be much more common, as I'm sure Jay could tell us, years ago. They're not as common today, one, because the banks pretty much got out of it until just recently. And there's very few banks that actually offer bridge loans today. But again, the big difference between the bridge loan and a HELOC, number one, the bridge loan is specific to a dollar amount that you're going to use as a down payment toward a home that you're about to purchase. And the institution knows that's what you're using it for. If you're getting a HELOC is a line of credit against your personal primary residence. That's why you can't have the home listed. In a bridge loan, yeah, list your home. We don't care. We know we're giving you that money to apply over here.
Is there normally a time window on a bridge loan?
Yes, usually 90 days.
Oh, wow.
90 days. Sometime, now, you can extend it. You can extend it. Each institution's different, that does them. But like my relationship for this kind of thing was Synovus. Synovus not even doing bridge loans yet. They're using the HELOC to accommodate that.
So it sounds like the bridge loan is less risk, but it sounds like it's more expensive.
It's not that the bridge loan is less risk. Why would you say it's
For the company.
for the
They're
bank?
doing 80% instead of 89, they're charging you origination, and they know where your money is going, instead of, here's money, hopefully you pay us.
That's a great
I'm
question.
just saying the origination fee, you didn't mention that on the HELOC.
No, there is no origination fee on HELOCs. There is on a bridge loan. There is on a bridge loan.
When there's less risk on that company's side, it's
Yeah, and interest rates are higher on bridge loans than they are on HELOCs. I know it doesn't make sense, but that's how it works.
Is it, so if you're getting a bridge loan from the same person that's gonna be doing your actual loan, will they ever package that origination fee just into your?
No, no. First of all, bridge loans are completely separate from a mortgage. Even if you go to the same institution, it's two different parts of the bank. You know, for example, the bank that I work for, from what I understand, they will do bridge loans in Tennessee. They're a Tennessee bank. So they'll do some bridge loans in Tennessee. But it's a whole different section of the bank than the mortgage company. And that's the way it is with pretty much all institutions. The bank does one thing, the mortgage company does something else.
So you're gonna be paying the fees?
You're going to be paying fees either way. Yes. Now, when should you use a bridge loan? When should you use HELOCs? If you have no time limit, first of all, if you've got a lot of equity in the house and you need that equity and you can afford to have two mortgages and you got to act on it right away, go get the bridge loan set up. But even bridge loans are going to take 4 to 6, 8 weeks to get completed. But you don't have to wait to start looking for a home. That becomes part of the advantage, because if you get the bridge loan, they already know what you're using the money for. So apply for the bridge loan right now and start looking for a house. List your home, doesn't make any difference. HELOC, on the other hand, again, the institution's giving you a loan against the primary residence that you own. They don't want that home listed. And you certainly aren't going to put in necessarily in the application that I'm using this money for my down payment over here. Although they may, you know, your personal banker at that may know that. That's fine, as long as they let you do it, who cares? And my contacts at Synovus, they're real good about it. They'll just say, hey, we know you're going to end up paying for it when you pay it off, so they're not out anything. So the difference is, if you've got to act right now, then you're going to have to find somebody that does a bridge loan. By the way, I know you might be asking me, Greg, do you know anybody that does bridge loans? The answer to that is no, I don't. I wish I did, but I don't have anybody. I just know the HELOCs. You've got somebody that does bridge loans. Who is it?
I don't remember the specific bank name, but I met them.
But I can call you and I can ask you for it. Good.
That's someone. Movement mortgage.
Who is?
Movement mortgage.
Okay, Movement's got a contact. Okay, good. I know there's some out there that do them, but I'm trying to move people toward a less expensive option, so that's why that's why I refer people over to the HELOC option, which I think is, as long as you've got 6 weeks to wait, that's probably a pretty good option. All right?
But on the HELOC, I guess you have fees in the rear if you close it too quick.
If you close that loan within 3 years, if you close the HELOC, then you have to pay your closing costs. That's why I said 100.
You use it, you have annual fees. Okay.
Right. All right, one last thing I want to spend just a moment on. We've been talking about this for weeks, but I want to share it because this weekend, the last 2 weekends, I shouldn't say this, the last 2 weekends, agents are calling and buyers are calling and saying to me, Greg, what's it going to take for me to get this contract to go through? Well, what I'm going to share with you is not what it's going to take. I'm going to share with you what I'm witnessing. And what I'm seeing in these contracts right now that are the most successful, ones I'm seeing that are happening most frequently, 0 financing, 0 appraisal contingency. I'm not saying that's a good idea. It's just what I'm seeing. Well, then how do you handle the appraisal? You got to give at least 7 days due diligence. and you got to get the appraisal in inside of that due diligence period. If you do that, now there's an expense to the buyer and some risk, because now the buyer is going to pay for an inspection, and the buyer is going to be paying for an appraisal, and the buyer is going to be paying for a rush fee on that appraisal. So how much is it? In our case, the appraisal is $475. The rush fee can be anywhere from $150 to double the price. So you're looking at somewhere between $700 to $850 or more. So they're going to be out $1,100, $1,200, $1,300 if they decide to walk away from the property. But those are the contracts I'm seeing that are having the most success with getting to the point of binding. So 0 appraisal, 0 financing, and 7-day due diligence, and the lender has to have it in there. Now, if you're not using me on that loan, be sure you're checking with your lender first to see, can they get that appraisal in? Because what happens, like just before I walked in here, one of my clients did exactly this. I spoke to her and her agent last week. The agent's not from this office. I walked them through this process, and this is what they did. The contract just went binding this morning, which means I have to have the appraisal in on Monday of next week. Now, I can't order the appraisal until all of the disclosures are signed. So we have to set up the regulatory disclosures. I can't even prepare the regulatory disclosures until I have a copy of the contract. Well, thank goodness they sent me the contract literally as I was walking. I just saw it come in. And so I'll send that over to my wife and Courtney. Today, they will get that out to the client. The client will e-sign everything, and then we can immediately order the appraisal. But that's how fast it has to happen. Brian?
Yeah, that's best practice for a buyer's agent. As soon as you go binding, the first person you send it to is your lender.
Thank you.
It's at midnight. And
Yeah.
you go binding, the first person you send it to
Yeah.
the lender
Yeah.
and closing attorney. It's like just, you
Yeah.
gotta get it.
Exactly, because we've got to have that in order for us to take the next step. And that becomes critical to get this done. And I know nobody wants, I mean, think about it. Jay, if you and I would have said that we're going to do 0-0 4 years ago, unheard of. But that's what it takes. So that's what we're seeing. But make sure if you're doing that you're getting that in, as Brian said, get that into your lender right away so they can take action immediately.
In your experience from what you've seen with those, if the appraisal does come in low, even with the due diligence, are they trying to negotiate or are they just walking?
Well, I'll just give you the example of Bob. Him and I did this last week, and we had to have the appraisal in by Friday. The appraisal came in on Thursday. It came in $25,000 low, and they didn't negotiate 25. They negotiated, I guess there were some problems with the house. They negotiated about $50,000 below the original contract price. So I think people are trying to work them out. I mean, if it's that close, they're trying to get it done, I think.
Usually if it's 0-0, you're gonna see some sort of contingency that they will pay X over the appraisal cost. I've got one in the contract, they're gonna pay $45,000 over appraisal costs. So usually if there's a 0-0, then there's an additional stipulation saying, we're not gonna get stuck if it's crazy.
Right.
Yeah.
So they're doing some sort of an appraisal gap number, makes them feel comfortable. Which, by the way, one of the other things I'm beginning to see now, which I really didn't see before, I saw it all the time on cash offers required, but now what I'm seeing on appraisal gaps, agents are actually including a bank statement that shows that they have the necessary funds to cover an appraisal gap. You know, cross off the account number and all that stuff, but they're starting to put them in. 2 of the ones that came in this weekend were done just like that.
And there's a preloaded special stip that says exactly that. Not only are we willing to pay more, here's the proof that we have more to be able to pay towards that gap.
Exactly, Jay. Thank you. Worrell? Did you? No? Okay. All right, everybody. Thank you. Appreciate it. We'll see you Wednesday at Golf Club of Georgia.